And what you gonna do when Hulkamania and the largest arms in the world run wild on you?
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 4th, 2022. S&P 500 currently sitting at 43.26. I'm here with one half Cogan, Dan Gorkuber, and the other half Cogan, Ian McMillan, which makes one full
Hulk Hogan.
Hulk Hogan.
It's a Hulk Hogan.
Yeah, it's the Hulk Hogan. And this is excellent. I'm David Zarling. Lots to cover this week. Let's hammer it, guys. What are we looking at for the market? Plenty of noise, right? Let's acknowledge some things. We've got Ukraine. Seems to be topic.
Yeah, definitely no shortage of distractions to go around.
Right. And when Ian says distractions, he's not saying downplaying that anything going on in Ukraine isn't important. It is. But when it comes to managing risk and managing assets, price is the only thing that pays. It's the only thing that makes sense to monitor, because you can have all the opinions you want about Ukraine and you're allowed to have those opinions. We have ours. But if that gets into the portfolio, some really bad damage can happen. And so we're going to continue to use price as our main guide, whether it's Ukraine, whether it's interest rates, whether it's inflation, you name whatever the topic is, whether it's, vaccine issues, you name it. We're going to focus on price. So with that, let's orientate our listeners. Where are we? Where in the past, we've talked about, for example, S&P 500, 45.30. We're below that.
Yeah, 45.30, everyone. Russell's not back. And, I think Russell's back below. IWM's below 200. So getting further and further away from that 209, 210. Yeah, IWM is sitting at 198. Stocks haven't really gone anywhere since late? Well, they got a lot of places and nowhere. When I say stocks, I guess we're talking about the major indices since late January. So it's just been chop, chop, chop for most equities. Obviously, there's been some stuff working out there. And I tell you where the strong trends remain in metals and commodities.
Yeah. And that's something that's in the 60-40 portfolio, 60% stocks, 40% bonds. I don't see a percentage point in there for commodities, and that means you're missing out.
Yeah.
So talk to me about commodities. What are you guys seeing in the commodity space, right? Because not all commodities are the same. I'm not saying there's a bajillion of them, but when we bring Dan on the podcast, all of a sudden we've got Kansas City wheat, Chicago wheat, and all these different wheats. What are we seeing in the energy space overall? And then maybe break it down to some things you guys are seeing specifically.
Yeah, you have specific to energy, you had the crude oils, the heating oils.
Crude oils, what, 215 or 115, 112, somewhere in there?
Yeah, and it's
wow.
It's probably I haven't looked at an ATR recently, but at least $5 of range per day on crude oil. So that's pretty wild. And then you have, you talked about wheat a little bit in the ag sector, but Chicago wheat, KC wheat. I think we've seen 4 limit up days now this week on Chicago wheat.
What's a limit update, Dan?
So that would be on the futures. Now we're talking the futures side of things, where they've seen a limit up move, similar to some of our indices that we have. The exchanges do put limit moves up and down on those products. And, as we've seen with Chicago wheat and KC, we've seen 4 days this week of limit up moves on those products. Now with wheat,
is that a percentage move? Like, what are we talking here? Like are they basically saying we're halting trading because
I think it's a dollar move? Am I wrong there, Dan? Is it a dollar move? I know
it's a net change. Yep. It's not percentage. It's more net change. So for example, it's 75 cents on Chicago wheat.
I know lumber is $45.
Sure.
So the wheat, would you say 45 cents?
75 cents.
Oh, 75 cents. And so you're saying that if from last night to this morning or something during the day, it moves that amount, they're going to pause trading.
Correct. Yes.
And then what Ian's talking about with lumber, same thing. And what was that? $45?
45 bucks. Yeah.
And so they're going to pause trading. And how do we know how long they pause for?
So normally it's like, for example, for today, it's a lock limit for the day. So like Chicago wheat didn't even trade today.
Really?
It literally just went right to lock limit.
Yeah,
so
that's happened. That'll happen a lot with lumber.
Yeah, exactly. Yep.
So lock limit means there's no trading. It's at its spot.
And we'll see you tomorrow morning.
Yeah.
Okay. Now, these are characteristics in this situation, overwhelming demand. So we're seeing lock limit up. So that means overwhelming demand for these type of products, such as wheat.
Correct. Yep.
And everybody can attach the narrative they want to that. I understand that Ukraine is, a big wheat producer. I understand that, the Black Sea or the way the conflict has gone down, that they've shut down a lot of shipping there, which prevents any type of wheat getting out. You can have whatever narrative you want. This move in wheat started before this, right? Like this move in wheat isn't new.
Look at that base. Yeah. I mean, I think you guys posted a couple of weeks back, about the wheat base, about some of these other bigger bases and commodities that, these things have just started.
Look at corn, right? Wheat has gotten a lot of the attention, but you could say the same thing for corn.
Exactly.
Yeah, exactly. And so here we are. We started out the podcast. We always start out with the S&P level, but here we're giving a bunch of minutes to wheat and corn. That tells us things.
Yeah, so the levels we've continued to talk about, and right, we talked about the S&P earlier. We can talk about, the NASDAQ Q's pretty far from 380, right? That's a level we've talked about ad nauseum. That if markets are going to correct themselves, then they will correct themselves, and we'll see them back above major behavioral levels. But
yeah, we got to get above 350 first, right? In NASDAQ 100. Got to get back above that, and then maybe we can talk about some of those things. What else? What else are we seeing? It can be equities, it can be commodities. I'll let you guys roll.
Well, this has all fallen through, right? To the equities side, we get on here and we bemoan that equities are all broken. Obviously, we know that's true, but we talk about crude, right? Oil stocks have remained strong. We talk about these commodities. Well, there's stocks that are linked to that as well, whether it's like your fertilizer names, your ag names, things like that, that continue to kind of ride these same trends. Gold, we talked about gold for a couple weeks. That continues to move out of this consolidation.
Man, you want to talk about something that brings out the passionate fanatics besides crypto? It's gold, right?
It is. And some of these, right? And so then these themes loop, I don't know what you call it, bottom up or top down, but they loop back to a lot of this strength we've seen from Latin America.
Good point.
Yeah, no, for sure. And it's all interconnected, right? Because you've got plenty of mining and energy.
Copper, new highs today for copper, I believe. That's a copper above 480.
Yeah, let's talk about that.
Big move.
This is great because, right, Dr. Copper, as everybody loves to call it, it tends to be economically sensitive. And here we're seeing economically sensitive or cyclical metals or base metals like aluminum, tin, nickel. You could throw copper in there as an industrial metal. We're seeing all these rip higher, and gold. So gold's typically your risk off, and these other ones are a little more economically sensitive, but they're all moving together.
Just metals in general.
Are we riding that commodity super cycle?
Palladium.
Palladium's testing, I think, highs as well.
Aluminum. How strong has aluminum been?
Yeah, absolutely. For sure. And it's been pretty broad based. We're sitting here talking about wheat, corn, aluminum, tin, nickel, copper, and now gold joining the party.
What's like interesting, you said, is silver. Sorry to interrupt, Dave.
No, go ahead.
Silver's been following along too, but not to the extent, but still a really nice base in silver, right? That's forming. And
well, that's a question I have for you guys, because there's times where typically in environments where precious metals are doing really well, you see silver outperform gold, or you even see like gold miners outperform gold itself.
Yes.
We're not necessarily in that environment.
We're not. So I love that you brought that up. And another kind of interesting caveat to this situation that seems different than would be your typical, we're talking about all these things going up, commodities and metals, is that it's doing all this in the face of the dollar's also ripping higher.
Yeah, it's a great point.
No, exactly. Yes. Dollar.
I mean, like this strength is pretty nuts considering that, right? We're obviously buying things that are based in US dollars, and to see this, because it's typically, I mean, that's kind of a textbook inverse relationship, is the dollar and precious metals or metals in general, in theory. So, but maybe we have found yet another relationship that the textbooks tell you it should be like X and it's like Y, and we can just toss that out the window.
Right.
And we just get to follow price.
And we get to just follow
because
price.
Right? You would be sitting here saying, of course I'm not going to buy gold because look at the dollar still up above 97. I mean, there's a lot of fundamental reasons to not be involved here. But as Dave likes to say, I mean, you take each chart on its own merit, and they've given you no sell signals.
Right. It is what it is. And what if it's just, if you look across the currency spectrum and you say, okay, what are the currencies doing well? Well, it's the dollar and it's the Australian dollar. You could argue the New Zealand dollar too, but the rest is from upper left to lower right.
And so we know Australia's a big mining hotbed.
For sure. You have to look at all these things in there. We look at things holistically, right? We're going to take all the things intra-market and intermarket analysis, of course. But then in the end, it comes down to what is that chart doing? And do you know how many times we see something move and you could be like, well, that doesn't make sense. Well, that's not my job to make it make sense. My job is to make money and manage risk.
Why is Berkshire Hathaway breaking out to new highs? I have no idea.
Yeah.
But it is like financials suck.
But Berkshire is going higher.
Yeah. And
is it because it holds so much cash? Could be, right? They're holding just a boatload of cash, and because the dollar is doing so well, and is that why it's doing so much better than JP Morgan in the financial space? We can rationalize and we can make whatever story we want up, and in the end, it's price itself.
Yeah.
So we had some pretty big moves at the end of, let's say last week. We also have monthly charts. We had Russia invading Ukraine, and there's an old axiom of, buy the invasion. And again, I'm not saying that as
that got passed around FinTwit. It was like 2 weekends ago.
Right.
Right. Because, look what happened in Crimea. Look what happened after Vietnam. Well, okay. If that's your strategy.
Yeah. You can never, past performance is not a guarantee of the future. Like we got to put the disclaimer on everything. So how are we going to associate every time that this is the same as the last? You got to use price. Kind of related to that, I know that we're a fan of Ryan Dietrich's work. He talks about what happens when January and February are lower, and that's what we experienced, right? January was down, February was down, and when I say that, I'm referencing the S&P 500. So it's kind of a mixed bag. I mean, about 58% of the time, March is higher. About 47% of the time, the final 10 months are higher, and it's all over the board. You can go anywhere from the final 10 months of the year are down, around 30% to it's up 24%. So again, another data point that you can't sit there and marry one direction or the other. You just have to use price to manage that risk and reward.
Well, and to me, and to that point too, it kind of sounds like, it's certainly more of a stock picker's market, right? Where we've seen more of that index style, passive style for so many years now. And yeah, you have certain time periods where stock pickers markets will show up, but to your point with those stats, maybe we're in a year of that, and it continues to show that.
Well, and you could have, we've had this conversation internally, and I know one-on-one with Pratty, we just talked about a two-way market, meaning there are some places you can be short in equities, and there's some places you can be long, and that pans out. In addition, how beautiful is it to have commodities, the cycle back, riding the commodity cycle again? That can be a differentiator. That can be a difference maker.
It could be a huge difference if you don't have to play around in stocks. If you are willing to go anywhere and do anything because the relative chart tells you to do it, you can really open up yourself to a world of opportunities versus feeling like, I gotta nail the bottom on, pick whatever small cap growth name you want to think of.
Mm-hmm.
Exactly.
Spot on.
Okay, so we all know the topic du jour of Russia, Ukraine, and there's a lot going on there as far as my understanding is the Russian stock market isn't going to open until next week, which means there's no price discovery happening. And you've got index providers like MSCI saying, and forgive me, correct me if I'm wrong on this, they're saying some of these companies are worth zero.
They're not worth zero. And this is the conversation I was having with Dustin earlier, I believe was his name.
Yeah.
Is that they're basically going to be marked to zero when redemptions, in theory, you're probably going to get $0 back. So we know that they're not worth, right? We know that these stocks are, but when there's no market, there's no one willing to say, let's buy and sell and meet in an agreement, right? Which is what creates a public market.
Yeah, it's interesting. These could fit the very definition of a falling knife. Like, they're falling at extreme rates. And do you need to be in the business of trying to grab these things?
And it's not just Russia, it's EZU, Germany.
All of Europe just looks brutal.
Yeah.
Brutal right now. Not that it.
Well, okay. So let's talk about that. So we're seeing, you guys are saying when Europe looks brutal.
Yeah. Look at the DAX.
So like the DAX is the German index, which is highly correlated.
40. So you've got the France. DAX. Now DAX gapped below today. Now the market's closed over there now, but gapped below the COVID highs, pre-COVID highs.
No bueno.
Back below like that 13,000, like 13,800 level.
I know you said no bueno, but I'm going to say Nick Sergut.
So
it's better.
That's a horrible look you've got, right? So the other big one over there, CAC 40 out of France. France,
right? Italy looks bad.
Italy, you've got Swiss market index, which is typically, not going to say it's like their flight to safety index, but Swiss assets in general, currency and equities, kind of viewed as that in theory. Also getting, breaking below these, October lows. What is that? Like 11,400. So, and basically retesting its COVID lows now. So you assume if the DAX is foreshadowing what's to come for the rest of Europe.
Yeah. So, okay.
You would assume that they all break below.
Well, and okay, here's a controversial question. And this goes back to price versus news, which moves first. We are seeing a lot of European equities break lower below important levels. Do we get to be surprised? And I do not mean this as like, I don't think the situation is serious, but do we get to be surprised if the situation gets worse because of what we're seeing in European equities now?
Oh, we know it. And we know it's not getting better till it breaks those levels we talked about earlier.
Exactly.
So, I mean, no, you can't be surprised. I mean, I think with a VIX above, where are we at on VIX? Definitely above 25,
Yeah, we're
32.
32 and a half, 32.
Well,
I don't even be surprised by anything.
And so we have this situation where, and I don't know where the counterparty risk starts to, because really when you start to think about the past from February 2021 through now, you've had a bear market underneath the surface in previous high flying names. We've covered ad nauseum, the cannabis stocks, the IPOs, the software,
Everything,
the ARC,
all the high flyers,
biotech, like all that high flyer, like the correction, like we're talking 40 to 70% down.
Yeah.
Now you're seeing international breakdown, with the exception, I would argue, of Latin America, right? Because even China's falling into this scenario.
Emerging markets also now below. They yesterday, and then with another big gap down today, below their pre-COVID highs.
Well, and remember, even last week we teased that we might talk about international this week and emerging markets, because they were positive year to date, and all of a sudden that evaporated just like that, and they're now negative on the year. And what's fascinating is, I shouldn't say fascinating, it just is what it is. Really, to be like, if you were a true deep dive what's going on in markets, the S&P 500 and the NASDAQ 100, they're not showing what has been going on.
It's incredible. Your retirement has been saved if you've been in S&P and the Qs.
Right. Because everything else has just been, and when I say everything else, I mean equity centric, stock centric, has been pretty much there's been plenty of carnage to go around. Let's put it that way.
Look what they did to European banks.
Yeah, European banks, they were looking so promising before. Yeah, and now they're not.
And look at we kind of teased it last week too, like that SPY ACWI ratio, the ACWI. I mean, that thing's going out at all-time highs,
And I shared the chart. We've got frontier markets making new highs against emerging markets, which just tells you China is abysmal.
Oh, let's walk real quick. Let's walk through. So you've got, and Ian, correct me or, push back. So when we think about economies and the equities associated with them, right, on the risk spectrum, you have frontier markets way over, let's call it on the left, right, higher risk, right, because it's frontier. It's the frontier. It's not even emerging. It's just frontier.
Yeah,
you got frontier
basically borderline third world countries.
Right. So you got frontier markets, emerging markets. I wish there was something that was developing, and there probably is actually developing markets, and then you have developed markets. You've got your well-established markets. Isn't that interesting that you can have frontier markets doing what it's doing while emerging markets and some of these major developed markets are just getting whacked? I think.
China is such a big chunk of emerging markets that it's going to be the tail that wags the dog, I guess.
Well, and how much was Russia too? Russia was considered in that picture, correct? Isn't Russia considered emerging market?
Yeah, but it was only of the MSCI, I think it was 2.5% of the MSCI index.
Okay, so not a big weighting there. That really comes down to China, India, and Latin America, then Russia. Is that fair? China, India, Latin America. I think that's approximate. So frontier markets, one thing I wanted to touch base on there. What are we talking about here? What's frontier markets? Where are the frontier markets?
Vietnam's number one.
Okay. So Vietnam's doing well, or relatively well.
Yeah. And I'm sure Malaysia.
Well, in the one area that it used to be, right? Kuwait.
Yeah. It used to be Kuwait that got bumped up to emerging.
So Kuwait's emerging market now.
But you've got Vietnam, you have Nigeria, Bahrain, Colombia, Peru. So the only, right, I don't know of any Bahrainian or Moroccan ADRs.
Actually, this is.
But you've got some other accessible areas
Well, you said
with
two
enough
names.
liquidity. Peru, Colombia.
Yeah, you said those two names, and definitely when you look at the Latin American, what is doing well emerging market wise is Latin America and Peru and Colombia specifically.
Yeah. Argentina.
So
Argentina just made new relative highs.
and again, that goes back to pivoting back to some of the mining and energy themes that we're seeing that continue to play out.
Well, and what's even more amazing too with that frontier markets is, I mean, financials make up over 35% of that sector breakdown.
Really?
Yeah. And so, just seeing that discrepancy there is, based on kind of what we've seen in the States in terms of financials lately versus like even something like in frontier markets. Very interesting.
Yeah, it is interesting. So before we wrap up the client portion, two quick things I want to touch base on is like surveys versus price. And since we've done a good job talking commodities, equities, we even touched base on currencies, we probably should talk about credit and fixed income, right? We've got, what's interesting is the 10-year treasury note yield.
Yeah.
Testing a really important level currently.
Yeah. Pratty had a good chart on that earlier.
Yeah. And so in here we have a scenario where your risk off. So gold can function in a lot of different ways, but that's a risk off type commodity to own. And if all of a sudden we see a bid on things like treasuries and the yen, that probably happens in an environment with continued equity weakness. And so there is part of me that wonders how much longer the NASDAQ and S&P can hold up. So, and we talked about this before, like there's only two ways this resolves. So all this other carnage that's taken place, we're either catching down to that from a broad indice perspective, or those things stop going down and we broaden out and all of a sudden we have the next leg higher, which would match seasonality. And then you would see a cooling off of credit, gold, those type of things. Or maybe they all go
Amazon
together.
and Apple continue to hang. I mean, Apple and Microsoft continue to,
go
down. I mean, Amazon doesn't look that. I mean, Tesla doesn't look that great, but
go there, Ian, because we've talked about this in the past. Microsoft and Apple would be the two, in my opinion, poster childs for. Well, and this goes back to the weighting, like what their cap size is. These things are the things you would see move down on a relative basis, and we're not seeing that yet.
No. I mean, they have been in, from their peaks, I guess, in a relative. I wouldn't really. It's not like they've broken below these highs from, like, if you look at Microsoft, from July. Apple might look a little better on a relative basis. I'm sure Apple looks quite. Well,
I was just going to say,
yeah, Apple's held up very well.
Yeah, Apple's held up really well, but on a relative basis versus the S&P 500, it is at a critical point.
Yeah, it's stalling. It's stalling at a very interesting behavioral level.
So there are pieces that are aligning to, like, I don't mean this is a fear statement because I hate this type of stuff. Either we're heading into a protracted bear market or we're not. And I don't pretend to know which direction this is. But if we see Microsoft and Apple fail on a relative basis versus the S&P 500 right here, right now, and this happens in the face of what's supposed to be positive seasonality, that would be very problematic.
Wow, that is scary. Dave's auditioning for a spot at CNBC.
I know Nan's going to give me a hard time.
I know.
Nan is going to call me and she's going to be like, why are you so bearish?
I'll
be like, I'm not bearish. I'm not. Because like I said, the flip side of this is if Apple and Microsoft break out to the upside versus the S&P 500 and these other things stop going down, right? Because we're having this huge flush going on, Russia, Europe, et cetera. And these other things, if they stop going down, all of a sudden we're going to have this huge broadening out. We could have a massive leg higher.
We could have a breadth thrust, but we have these pops, right? We've had a couple 80% days in like the last month, haven't we?
Yeah, but we can never get back to back, right? We're 0 for 6 according to Walter Deemer. We're 0 for 6 on.
I see that.
There's been 6 times where we've had an 80% update and we can't follow it by a subsequent the next day on 80% update, which would be a type of breadth thrust, which is important. And you guys can go back and listen to the podcast from, March and April of 2020 to understand what those are. Breadth thrusts are important, and we haven't been able to get those yet.
Like 0 for 6 since late December.
Yeah. And this is happening in an environment where, let's talk about surveys and price. Let's talk about the AAII bull bear surveys. Where are we at in those? Well, first, what are they?
I still have never gotten, no one's ever asked me.
Yeah, I never got a phone call.
I want the phone call.
And are the
no one
surveys,
ever asked. It's like whenever they tell you in like TV, they're like, oh, we polled 3,000 voters. Never been polled.
Never.
And is everybody on the survey truthful too? Is that
exactly because I vote differently on Twitter polls than I truly feel.
Well, and that goes back to like
Ian playing games on Twitter.
Yeah, and are you playing games with anybody who's taking a survey? Like, okay, you've got the true diehard who's like, ooh, I'm going to give them the best information I can.
Yeah, I just say it to feel the opposite. Then I just look to see what the general public said. I also I think it's a superstition thing.
Sure.
Oh, is this like the Packer fan who makes a bet against the Packers and it's a win-win? Right? Because if the Packers win,
well, I would never put money so there's the difference against that's dumb because I still don't want to lose money, but if it's just a survey, okay. I would not say, well, I'm going to short gold because I also am a fan of gold. And if gold goes up,
or the survey says that,
well, and here's where I'm going with this, this AAII survey, which is surveying asset managers or people who have supposedly market exposure and they're at the bearish that they've ever been, like similar to March 2020,
which is remarkable.
So now this goes back to we've seen corrections to start the year, anywhere from 8 to 15-ish% if you're looking at US indices, much worse if you're looking at international equities. But that doesn't mean you have to be positioned that way. You can answer one way and be positioned another.
Well, and this is
Bill Ackman does it.
Point where if everyone's bearish, at some point, I'm sure everyone was super bearish in October 2008, and people are like, "Oh my God, look how these silly institutions, they've never been. Oh, they're so bearish. No one owns anything." And then stocks continue to fall for another 5 months.
Right.
So I know that it's always this contrarian thing. I mean, there's been so much contrarian stuff thrown around lately, and those surveys are a big one that gets used. And again, I go back to it's a heck of a way it's a really ballsy way to manage your money, or in our case, other people's money.
Yeah, you can't do that. You can't use survey information to dictate your exposure level, but you can use it as environmental information. And my point is, if people are truly this bearish, right? Because all we have is a wall of worry in front of us. All we have is the Ukraine conflict, the inflation, rate hikes, vaccine issues, you name it. There's a wall of worry here. And could we climb higher out of here in an environment where everyone's bearish and we have a flushing of the system, meaning you've got this correction that already happened underneath the surface? You absolutely could. But until price confirms that, until, the NASDAQ 100 is above 3050, and, what we could pick all sorts of levels for the S&P 500.
I got levels. I got lots of levels out there on lots of assets that need to be overtaken before I'm remotely bullishly constructive on the market.
Yeah, we're still below 200-day moving averages. So
it just start to roll over with every day that goes by, and stocks don't go higher.
Right. And I know that everybody loves to have conviction and predictions. How about we just use price? And if we're above certain levels, it's confirming a certain thesis. So right now we just have environmental information of what's going on around us. if price moves above important levels, such as 4530 on the S&P 500, such as 350 on the NASDAQ 100, such as 209 on IWM small caps, then yeah, we can be interested in equities more fully. But right now, the environment is energy, commodities, weak equities internationally. Not, there's certain areas you can be domestically, like energy, like I talked about, and just let it play out. You don't have to marry your opinions. Anything else you guys want to touch base on in this part of the podcast before we jump to the extended portion?
Well, I think it's just important too to say, hey, like to mirror those points, say, hey, we're an adaptive team, we're an adaptive market that, we kind of mentioned earlier, we want to be in those stock picking or those market type picking situations where, yeah, we need to know the levels of the S&P, and that's fine, and the NASDAQ and the Russell, but we also know that, correlations aren't always, 1-to-1 and +1 or -1. So, we can adapt to that, and that's what's great about, our team. So
exactly. Ian?
No, I mean, not much to add. I just don't. I mean, we've been beating these dead horses, and I say that right on. I mean, a good way, right? we're not going to come on here and talk about software because, it's not working. But right? We've had no really change of trend in the areas that we've continued to talk about for weeks, and until that changes,
we'll change with price changes. How about that?
And maybe that's Monday. Like we always say, maybe that is Monday.
Yeah, could be.
But we'll see.
Well, we will see. And that's what's great about markets is we will see. Price knows more than you or me or anybody listening. And that's awesome. We appreciate everybody listening. We hope you guys stay on for the extended portion. Plenty to cover there. Stick around. Check it out. Otherwise, have a great weekend.
Have a great weekend, everyone.
Have a good one, guys.
All right, gents, jumping into the final part of the podcast, digging a little deeper into the technical part of things. We love ratios because they give us, right? Everything is relative.
Mm-hmm.
Any ratios that we're seeing that are worth highlighting, relationships worth highlighting that can give us some clues or insight in.
I would say, well, I guess going back to this metals and mining theme, and kind of our industrial metals versus precious metals. They could both go up at the same time, which they've been doing. So it doesn't always have to be a risk on, risk off thing. But copper versus gold. Seeing another big bounce in that channel. Both have been acting well on an absolute basis, but obviously as a portfolio manager, sometimes you have to ask yourself, well, which one should I own?
And the simple way to do that is just to compare one versus the other, right?
Yeah, one versus the other. You can do this with any asset, right? Relative strength works. You can compare any two assets against each other.
Well, and to your point, what's awesome about using that type of ratio, that relationship, is you can say compare one versus the other. And I know the copper gold ratio would be considered risk on versus risk off, right? Copper moving higher would be a risk on, gold moving higher would be typically risk off. But what if you have an environment where they're both moving up? Surprise, surprise, that's what we have right now. Which one are you going to own? So you do that ratio, and what are we seeing? What are we seeing in the copper gold relationship?
It's had a big bounce this week. I'd still say it's range bound, until it gets over. I don't want to call this level. I don't have the perfect level in front of me.
Like over October 21 highs.
Yeah, I mean, I think that's a great way to put it. I think you want to see it get over the October 2021 highs.
So it's a tight consolidation.
It is. It's been going on for March 2nd, 2021. So a year and 2 days. And
we're fans of saying from compression comes expansion. And what I think is fascinating is that if you do get expansion in the relationship, I mean, you could definitely argue that both of them on an absolute, just looking at them one by one, side by side, not in a ratio, they could have some tremendous upside. So it just means one's moving faster than the other.
Yeah, and Straza and Ian Coley, All-Star Charts, both had some good views on this yesterday, kind of this shorter term and longer term. There's so much potential in both of these areas.
Yeah, for sure. We just closed out a month, on Monday. I can't believe 2 months are gone in the year already.
Quick.
Wild.
Yeah.
Wild and quick.
Yeah, it is going quick. So so from a monthly standpoint, monthly data, monthly charts, anything that stands out to you guys, January and February, maybe even heading into March?
Well, I mean, you can probably continue on the theme of like Ian said,
metals
being a
and
dead
mining.
horse of metals and commodities and just seeing incredible action there. I mean, you could also go to the stance of, just some of those falling knife type charts of, some of those Russian names, or even just emerging market names that are continuing to really break down.
How about semiconductors versus S&P, right? So, got back to, actually broke above the highs from 2000 back in November and on a monthly chart. And that has continued to teeter, and that came, on a monthly divergence.
Yeah. And I think that matches
play out.
Selfishly, a chart I shared on Twitter about QQQ versus S&P.
It does. It absolutely does.
We were holding this important level that goes all the way back to 2000, February 2000. So here we have semiconductors, which we've talked about how many times as being a bellwether and something we want to see move higher, breaking on a relative basis to the downside with a divergence. And here we have the NASDAQ 100 versus the S&P also below important levels that were like, it's February close, basically. So that's it. I mean, talk about some red flags, at least for growth and tech and those type of things.
Absolutely, yeah. And you've got utilities, trying to recapture some relative lows, depending on which utilities ETFs you want to look at. Obviously, I mean, energy monthly candles, nothing new. I mean, January, February, off to another great start in March.
Well, another interesting one too is that HYG IEF. I mean, you look at the monthly of how we closed that monthly in February and how we're already back below it.
So high yield bonds versus your typical
7 to 10
year
yep.
government bond. So here you've got
Wow. So you had a decent shadow there,
right?
And in 4 market sessions, we're back below that.
Yeah, and so, typically when you see that relationship,
and a nice weekly candle last week, that you looked like it was going to save kind of this range, but it's a good catch there. Quickly reversed,
shortly lived.
And so, are we seeing, like, if we go out on the duration spectrum, if you will, treasuries out in the 20 plus? What are we seeing there?
Yeah, I mean that one, very seeing kind of the last couple of weeks, we can kind of noting the, those lower shadows. I've seen.
Then
some
you look at the monthly.
I
mean, that monthly upper shadow in February is.
Are you looking at something like TLT, Ian?
I was looking at 30-year yields, TYX.
Oh, TYX,
sure,
yeah.
Yeah, so
so again, the opposite of, if you're looking at TLT.
Yep.
And what about Qs versus Russell 2000? Big. I mean, you go back to the COVID lows. I mean, that relationship was pretty wonky from March 2020 through, really the next 8 months. But you go out to, that was a big, nasty red candle in that relationship in February.
Yeah. Well, that goes back to, okay, so are we going to see, right? So, okay, in general, higher rates, we're going to see value do better. In theory, you're going to see your energy and banks do better than tech and, your high growth type names. You might even see in a higher interest rate environment, commodities do well, which is what we're seeing. Are banks out of the woods here? Are we good on banks?
No, I'm skeptical of, right? I mean, they're going to trade on rates. But banks, like regional banks, okay, let's take KRE.
Okay.
Unable to break and hold the $73 level, continues to lose momentum, hasn't been overbought since mid-January, relative chart stalling out at, a pretty obvious level. I hate to say it, I love banks.
Okay, so related to, yeah, go ahead. I'm sorry, I interrupted.
On an absolute basis, they look very, they're kind of hanging by a thread here.
Yeah,
really
so
are, yeah.
There's two things I wanted. So Pratty just messaged me and shared a weekly chart. Again, we're cheating, right? Because we're less than 2 hours from close on Friday, but it's fair. It's a fair chart.
I see. Yeah.
JP Morgan.
That's
look at that.
Look at that. So you're again back below JP Morgan below pre-COVID highs is not a good behavior. You're telling me that investors want to pay less for this than they did back in January 2020?
And so to paint the picture for you guys, JP Morgan currently sitting at about 132.80, below 140-ish, 139, which is where the COVID crash, panic crash happened for this particular stock. And JP Morgan's a bellwether.
Yeah.
Right.
And others have like Morgan Stanley well back above those highs. Bank of America, not close to its COVID highs. But again, we talk about foreshadowing and super important. JP Morgan's a very important stock.
Well, and it makes sense.
Talking about Deutsche Bank,
Yes. Yeah.
Yeah.
And it goes back
to a lot of those.
that.
Lloyd's Group that had broken out. I think they're in the United Kingdom, but it's going to go out to new 12-month lows today.
And this goes back to value versus growth. And so an interesting chart that I look at, and we can look at it on a daily, is look at MGK versus MGV. And we are now below important monthly closing lows in that relationship, which confirms the value. Let's get some value. Like I'm just so happy because my wife has been bugging me about buying value stocks. And I told her I'll buy value when it has momentum, and it's here, and we've been doing it. And she's been just so happy that we're buying value with momentum. And this chart is confirming it, right? MGK versus MGV is sitting here telling us, okay, we did have that little hiccup last week, but now we're confirming the value versus growth relationship.
And this is this is without Apple and Microsoft participating in this. They're not really participating in the mega cap growth weakness.
Yeah, great point.
So what happens? You can only hold up, right? You can only hold up as a foundation of a house so long until it's going to catch, or it does.
Right. I was going to say, so Apple
have a 50% bear market and Microsoft and Apple are down 10-15%.
No, that's absolutely appropriate to say. Microsoft and Apple, they're either the rock or they're about to become the sand on which the house is built. So either they're going to be steadfast and we're going to see large cap growth hold up, or if they start to fail, it's going to be the thesis of the broad indices catching down to the carnage that's happened underneath is in play. It's one of those two things. Yeah, good point. So
that's huge. Yeah, that MGK, MGV is huge development.
Yeah.
And even just looking at an Apple versus Exxon, ratio of that.
Yes.
Just seeing the level that that's at. I mean,
right? Because I
talk
think
about
that's a great
critical.
example. Those are two extremes in both. Yeah, look at that. I mean, that's close to hitting
It's huge.
It's just such
new
a critical
lows.
area. Yeah.
Yeah,
It continues to get oversold. You would think that that's at least going to go back to these March 21 lows. It's not that much further.
Well, and what I love about this is how, if you had said 18 months ago, guys, there's going to be a pretty decent market correction, but you can hide out in energy.
Right.
Like
I would have called you crazy.
Yeah. You'd have been like, am I in a dream right now? Are you yelling at me in a dream about hiding out in energy?
Yeah.
No.
I mean, I'm buying Interior Resources and chemical stocks and coal and
Coal.
it's
Did
wild.
Santa give you coal this year? Is that no?
We won it.
I wish he had. If
Yeah.
Santa had given me coal, I'd have a Ferrari in the driveway.
Hat tip to Kevin there.
Maybe Santa didn't. Yeah, hat tip to Kevin. Maybe Santa didn't give coal this year because it was so expensive.
He knew he was hoarding it.
Yeah, he was cornering the market. Real quick before we close this down, there's really two other developments here that I think are worth noting. And credit to Dan for putting these on the show notes, but the relationship of industrials versus financials, and then what we're seeing in transports, right? Dow theory, et cetera. What are we seeing in those relationships? Let's just start with industrials versus financials. What do we have there?
I mean, just on that ratio right now, I mean, you're breaking down a pretty big level again with XLI, XLF. So XLI with being the numerator there in the relationship. I mean, you were breaking down pretty hard, and now just this week here, you're breaking back above this level. Just to name the level, we're probably going to use like a 260 on that one.
Yeah, 2.6. Yeah, that's
2.6 on that one. So is that? I think it begs the question, is that more of a strength of industrials or is it more of a weakness of financials? Right now you could probably argue a little bit of both, just with the weakness we've seen in financials. But, within industrials, we have seen, the last 2 to 3 days, the team here, we've really been pointing out just some of those rail companies, some of the transport companies that, are holding pretty well, both on an individual basis and on a relative basis as well. So,
well, I think that brings up an interesting, because you brought up, industrials, and when we talk about, market cycles, and I guess I kind of want to touch base on this, is that when we look at market cycles, and I shared something with you guys, what's interesting is seeing, right, we've got commodities up.
Mm-hmm.
And bonds and stocks down. In the business cycle of expansion and contraction, this is peak type behavior. Right.
Yeah.
And so do we have that upon our hands? And again, I'm not calling for a protracted bear here, but this is this stage five type situation where we have commodities outperforming.
I mean, this is much more of we're creating a top. We have spent months creating a top in the market versus a type of March 2020 correction.
Yeah, and that's how tops happen, right? They happen through time.
Distribution.
Yeah.
Now, yes, clearly there was distribution in March 2020. But I mean, this is pretty significant. I mean, you want to look at how you go back to 2000 or 2007, 2008. This is how tops are, for lack of a better phrase, constructed.
Yeah. And you're seeing characteristics met of when you see basic materials and industrials and energy and staples do well near tops of markets.
Yeah.
And again, I'm not calling for that, but if we don't get to be surprised 6 to 12 months later if we're lower in broad indices price, that you couldn't have seen this coming, because all the pieces of evidence are lined up. Commodities higher, bonds lower, energy higher, staples higher, basic materials higher. These are the things we see towards market tops.
Mm-hmm.
And again, I hate being in No one should be in the top calling or bottom calling business. You just use price.
Well, I don't think we have been yet. It's not like we were standing here, if we look back on, whatever the top ends up being, like I always say, I mean, we're going to be aggressive, probably pretty aggressively long at the top. I was not calling for a top in December 31st.
No.
We had broken out to new highs on December 29th. So sometime back in then, 27th.
Well, we don't get to say we're in a bear market if we're back above a 200-day moving average, or we're back above 4530 in the S&P 500. You don't get to say that.
And if we start to see breadth thrust, then hey,
yeah, we need to see that. We need to see breadth expansion at this point with all the stuff that's happened underneath the surface. With all the previous high flyers that are down anywhere from 40 to 70%, with international stocks getting crushed over the past 3 weeks. And yeah, I get it. You guys, there's going to be people who would be like, oh, that's all the Ukraine thing. That's fine. But you can't deny everything that's happened with commodities, even in the face of a rising dollar. So you just have to take each chart on its own merit. You have to take price as price. If we're above those levels, great. Like Ian said, we'll get aggressively long, no problem. But for right now, there's money to be made in other areas of the market and reduce risk in equities if the weakness continues in equities. Fair assessment, a fair way to close down the podcast.
Yeah,
absolutely.
Awesome. Anything else before we close it down you guys want to touch base on? I don't want to just snap the door shut in case you had one final point to make. Anything, Dan?
Nothing from my end. Thanks for following along this week, and look forward to getting after it next week again here.
Awesome. Ian?
I just think it's a shame that AMC shareholders are never going to see $20 again.
Ouch.
I love it. Bam.
Ouch.
We're going to do that. We're going to close it down here. We love everybody that listens. This is fantastic. Everybody enjoy the week ahead, and we'll do it again next Friday. Thanks, everyone.
Thank you. Have a great weekend.